Hello, everyone. Welcome to Ancient Roman Trading Secrets with General Romulus. That's me, Romulus. This show, as usual, is sponsored by Backpack Trader. We aim to help you become the best version of the backpack trader you can possibly be. The bears have been feasting lately, but it might be time for the good old bull to get in front of the trough and stuff his very sharp face in there and get a little something to eat. See there, a lot of losses have been incurred by investors around the world over the last several months, really to start the year 2022, anywhere down from 15 to 30%, depending on the index, depending on the particular risk profile of an investor's bucket. I'm hearing from some people that are not in the Centurion Nation, and they're down 70 and even 80% so far this year. Look, you lose 80% of your money, that's a tough sled to try to pull back up the hill. But as I mentioned, it looks like there's an opportunity for the bull to start feasting a little bit after the bears have just been absolutely gorging themselves over the last several weeks and several months. A little bit of a break in the downside action. It looks like that could carry forth for just a little while. But let's find out, shall we, how much longer that can possibly go. And before we do that, let's always remember that bulls and bears both, over the course of Wall Street, they eat, they get fed, but the pigs, well, the pigs get slaughtered. And that's just a lesson not to push things too far after things have been pushing far enough. Okay, on May 3rd, 2022, just a couple of weeks ago, a video was released with your old buddy Romulus, talking about ancient Roman trading secrets, and we did a little study on geometry. That's right, triangles. We drew this descending triangle. A descending triangle is typically a bearish pattern that usually results in lower stock prices once that bearish pattern happens to be fulfilled. And on May 3rd, you could see the pattern had just been fulfilled, and the S&P 500 at that time, here it is, you can see it, at that exact time, was 41.55. Okay, right there, the price on the S&P 500 as this video was being posted, and as I was stating clearly that this was a descending triangle, the price on the S&P 500 was 4155. Let's mark that, everybody, 4155. And we talked about a descending triangle being a bearish pattern, typically resulting in lower prices. So let's follow it, shall we? Okay, here we go. We're back on the chart. Let's put it back to the line right there. All right, so the pattern breaks below the descending triangle, right around in there, okay, right there on May 3rd. And then, well, it came true to a degree, didn't it? Lower prices were quickly followed. The low right now on May 12th last week, 38.58. That represents a 7% drop in the S&P 500, and that money could have been yours if you're listening to your old buddy Romulus right there. All we were doing was studying a little bit of geometry. Nothing scary. This is not trigonometry. It's not advanced calculus. It's not rocket science. Just a little shapes, everybody. The triangle right there. It was yours for the taking. For the taking, absolutely. So the pattern breaks down. The price breaks down, through the bottom of the pattern, confirming the descending triangle. What happens next? That's the most important question that any trader and investor should be asking themselves. Not why, but what happens next? Well, according to history and my own trading experiences, it is not uncommon once a price breaks below a pattern like this, or even above a pattern, to experience what's called a retracement back to the range of the pattern. The lower line right there, that's the bottom of the descending triangle. Looks like it's got a price of roughly 41.60, give or take. And there is a high probability, not a guarantee, of course, but a high probability that the S&P 500 over coming days or weeks will make a return trip somewhere in this neighborhood. Doesn't have to be exactly that price. Could be 1 or 2% below it. Could be 1 or 2% above it. But somewhere in this neighborhood coming over the next couple of weeks. And then more likely than not, a resumption of the downtrend, and eventually between, let's say, now and the end of September, breaking the lows set on May 12th of 38.58. So that's your highest probability outcome over coming months. Again, between now and the end of September. A return trip to somewhere in the neighborhood of this purple line, either 1 or 2% above, 1 or 2% below, something like that. And then a resumption of the downtrend that has been in place since January 4th, with eventual break below the lows on May 12th of 38.58. That is within the S&P 500. Of course, there's a lot of other action going on within the stock market. We saw Bitcoin and the cryptocurrency world just get totally obliterated last week on some news that really just rocked the crypto world to its very core and foundation. This is far more important and has far more reaching implications than what happened in 2017 at the end of that year when Bitcoin reached almost 20,000 and then retraced that entire parabolic move all the way back to slightly under 4,000 within a couple of months before resuming its uptrend until finally peaking at its all-time high back in November of just shy of 70,000. Right here, I've had a target on Bitcoin of 20,000 for, well, a long time, going back to right about in here. And it almost hit there the other day, 25,000 or so. I am maintaining my 20,000 target on Bitcoin, but again, it could be months. It could be several months before that target is hit. And as we continue here, but the news that really rocked the entire foundation of the crypto world was what happened with the Luna Terra situation, which right now they're both trading at zero. Sometimes smart people try to be too smart for their own good. And that has been a bit of a consequence of the crypto world. Brilliant, absolutely brilliant mathematicians, computer science engineers coming up with all kinds of different formulations for cryptocurrency applications. And sometimes, again, they're just a little too fancy. As you can see here, this was trading at 120, almost $120 a little over a month ago, and now it's at zero. I've seen stocks go down quite a bit in a short amount of time, but a loss of that magnitude in only a month, I don't think I can remember anything quite like that. Not even Bear Stearns in 2008, not even Lehman Brothers, not even WorldCom or Enron fell quite that much that fast. Okay, so this is a reason for great caution in the crypto world. For a long time, I've been wondering, there are 16,000, well, now there's one fewer coin, 15,999 cryptocurrencies in the world. And for quite a while, I've publicly wondered what's going to happen to all these over the course of this bear market. Because in the stock market world, like in the dot-com crash back in 2001 and 2, and the financial crisis situation in 2008 and 9, stocks, they delist. They go from the New York Stock Exchange or NASDAQ over to the pink sheets or the bulletin boards, or they get taken over, they go bankrupt. There's a lot of ways that these things, this deadwood gets dealt with. But in crypto space, I wasn't really sure. Well, now I know. They just go to zero and that's it. And they kind of just, trade at 0.00001 of a penny, and basically they disappear. So I guess that's going to continue to happen to thousands and thousands of them. I think Bitcoin can survive. I think Ethereum can survive over the next several years. There are good applications for these cryptocurrencies, but the many, many thousands that are out there, no, they're going to go the way of the Lunar bird and the Terra bird and eventually become extinct. Oil prices are on the move again, which is going to create a little bit of a problem again for the Federal Reserve as they try to stamp out this inflation. I went to the store this morning and I had to go chip off a couple of pieces from the gold bar deposit in the basement of the safe in order to fill up my grocery cart. Absolutely unbelievable. By the way, everybody, you ever heard of Charles Dow? Perhaps you have. Charles Dow invented the Dow Jones Industrial Average, and he also invented the Dow Jones Transportation Average. And a lot of averages and indexes have come to be. By the way, there were no indexes prior to Charles Dow. Isn't that amazing? So in 1896, he invented the transportation and the industrial averages, and the rest was history. However, there is a theory, a trading philosophy, and a method where Dow Theory applies to trading and investing. And I have a free training session, a free video training session for you if you'd like to get that regarding Dow Theory. And I've updated it for modern times, which is critically important because, again, Dow Theory was invented in the late 1800s, early 1900s, so it's well over 100 years old. It did require some updating in order to be helpful and applicable to today's trading and investing environment. I have a free training video session. All you have to do is click that link right there. It'll be below. Click the link, fill out the form right there, and we will get you the free video training session for the Dow Theory. Speaking of energy and Dow Theory, here we've got energy stocks themselves. This is the companies like Exxon, Chevron, and other companies that actually drill and transport and service the oil and gas industry. There's a basket of them trading through the ETF XLE, and it goes to another new all-time high just yesterday. However, another negative divergence in here. This requires caution. Okay, what this means is if you're involved in energy stocks, which a lot of people are, a lot of traders and investors have rotated into the energy company industries in the past several months, be very, very careful. This requires extra caution. How do you deal with this? Well, perhaps you want to take some partial. This is a partial profit-taking opportunity, not a full. Partial profit-taking opportunity inside of the energy sector. Raise some stops, get them a little bit closer to where they're trading right now, and be prepared for somewhat lower prices over the next month or two in the energy sector. Again, another negative divergence. These negative divergences started showing up on May 8th. There's a series of new highs in the price. There's a series of lower lows, lower highs in the indicator. That shows a slowing of momentum, which typically, not all the time, but typically can be a foreshadow of lower prices in the somewhat near term. So again, be careful with the energy stocks right now. Raise stops up. Do not initiate new capital into the energy sector right now. That's unwarranted, and be prepared for lower prices coming over the next couple of months in the energy stock. Well, this is your old buddy Romulus. I've got to get myself back to the forum in ancient Rome. Again, click that link right below. You see it right there, the Dow Theory. If you click that, fill it out, we will get you a free training video session about Dow Theory, updated for modern times. Again, this is General Romulus, and this has been Trading Secrets from Ancient Rome.